India Business Insights is back with another update on the Indian economy. Earlier this month, RBI held a meeting of the Monetary Policy Committee and important decisions were taken. Stay tuned to find out more. But first, if you enjoy our content, please hit the like button, share our videos, and do not forget to subscribe to our channel. Click on the bell icon to receive alerts of new content. Monetary Policy Committee. In the recently held Monetary Policy Committee meeting, repo rate has been raised by 35 basis points to 6.25% in the fifth consecutive hike this year. Since May, the repo rate has increased by 225 basis points in total. The standing deposit facility rate has increased to 6%, while the marginal standing facility and the bank rate are now at 6.5%. With concerns regarding a global recession becoming stronger and geopolitical tension exacerbating the issue, the RBI has maintained a hawkish stance for the past few months and is unlikely to return to an accommodative policy in the near future. Based on the central bank's assurance of keeping an Arjuna eye on inflation, at least one more hike is expected in the current fiscal year. Let us now examine in greater detail the economic context in which the decision has been taken. NSO's quarterly GDP data shows that the real GDP during Q2 has been estimated at 38.17 lakh crore rupees. The growth rate has moderated to 6.3% year-on-year in Q2, which is almost half of the 13.5% increase in Q1 of this year. This slowdown can be attributed to the fading away of the base effect and the global slowdown. The pent-up demand due to COVID-19 having run its course also contributed to the lower growth rate. Mining and manufacturing sectors contracted by 2.8 and 4.3% respectively, lowering the year-on-year growth of gross value at constant prices to 5.6%. This is the first time since the first quarter of 2021 that the manufacturing sector has contracted. Rising input costs coupled with supply chain disruptions and weakened external demand put a downward pressure on profit margins. Services emerged as the front-runner with trade, hotels, transport, communication and broadcasting services expanding at 14.7% on a year-on-year basis, leading the pack. The return to normalcy in the post-pandemic period boosted these contact-intensive sectors. Agriculture, forestry and fishing maintained its resilience, accelerating for the third consecutive quarter. Between July and September 2022, it grew 4.6% compared to 3.2% last year. It is the only sector whose GVA growth rate in this quarter exceeded that in Q1 of this year. World Bank revised India's predicted GDP growth rate upwards to 6.9% from 6.5% in light of India's continued resilience and the Q2 results exceeding expectations. The Monetary Policy Committee, on the other hand, reduced the forecasted growth rate to 6.8%, attributing to the stickiness of the core inflation and the impact of international events. External sector. As per RBI data for Q1 of the current fiscal year, India's current account saw a deficit of $23.9 billion as opposed to the $6.6 billion surplus in the same period last year. For the second quarter, the situation may even be worse. NSO's quarterly data showed that while exports grew at around 11%, imports on the other hand surged at around 25%. This worsened the net exports situation. The overall trade balance for April to October 2022 period stood at a negative $98.52 billion to negative $34.05 billion for the same period last year. As per the Ministry of Commerce, between April and October 2022, the largest share in India's exports belonged to petroleum products, which was 21.74%, followed by chemicals and related products and gems and jewelry. USA emerged as the top export destination, accounting for 17% of India's exports. Exports to China declined by 33% during this period. Among imports, petroleum, driven by the high demand for crude oil, accounted for almost 30% of India's imports and had the top spot. Gems and jewelry and chemicals and related products followed. With a share of 13.77% in India's imports, China was the leading trade partner with regards to imports. Despite the Russia-Ukraine conflict, imports from Russia grew at an unprecedented rate of 413.12% between April and October. The World Bank, in its Mitigation and Development Brief, said that India is expected to receive $100 billion in remittances in 2022 and emerge as the top recipient globally. They are expected to exhibit a 12% growth compared to 7.5% in 2021, with an expected absolute increase of $11.6 billion. Despite this, they are expected to account for only 3% of the GDP. The shift away from low-skill salary jobs in the Gulf nations to high-skill salary positions in high-income countries like USA, UK, and East Asian nations has helped improve remittances as disposable incomes have increased. Fiscal stimulus packages during COVID-19 helped immigrants, and rupee's depreciation against dollar has further sweetened the pot. Currency. The rupee has been depreciating for the last 5 years. However, 2022 has been the worst. So far, rupee has depreciated by around 10% against the dollar in 2022, hitting its lowest point of 83.29 in October. A stronger dollar, supported by US Federal Reserve's incessant rate hikes and foreign institutional investors' outflows amid rising geopolitical tension, hampered the rupee's momentum. Rupee has been much more stable in comparison to other currencies like the Japanese yen due to strong fundamentals of the Indian economy and lower inflation compared to other economies. Since mid-November to early December, it had been relatively stable, moving between 81 and 82 rupees per dollar. The US Central Bank raised its benchmark interest rates by 50 basis points. The hawkish stance is likely to continue until 2024. Such rate hikes shrink the difference between Indian and US interest rates. As a result, the Indian markets might see an increase in capital outflows as India is considered a riskier investment destination as compared to the US market. Consequently, the rupee may weaken further in the near future. India's total foreign exchange reserves stood at $561 billion on December 2. With 4 consecutive weeks of expansion, reserves have reached their 3-month high. This is mainly owing to dollar index lowering from peak levels, revaluation of other currencies, surge in FPI investments, as well as the central bank's market operations. Despite some recovery, the level remains much lower than the $606.47 billion at the beginning of April this year. This is partially due to RBI's efforts to bolster rupee. With the net exports not likely to catch up with the import bill, the current account deficit is expected to widen, and experts predict that the reserves may fall in the near future. Now we come to inflation. The annual rate of inflation in the Wholesale Price Index (WPI) for November 2022 continued its downward trend and eased to 5.85%, a 21-month low due to fall in prices of food articles, basic metals, textiles, chemicals and chemical products, as well as paper and paper products. While all segments showed a downward trend in rates, inflation in fuel and power segment remained the highest at 17.35%, while the manufactured products was at the lowest at 3.59%. Easing of the WPI is expected to help industries improve their margins and support better performance in the coming quarters. Inflation in the Consumer Price Index (CPI) reached its 11-month low of 5.88%. This is the first time in this year that retail inflation is within RBI's mandated tolerance band of 2 to 6%. However, it is still quite high compared to the 4.91% inflation in November for the last year. This decline was brought about by lowering of food inflation. Inflation in the Consumer Price Index was 4.67% as against 7% last month, driven primarily by reduction in vegetable prices. Rural inflation remained higher than urban inflation, coming down to 6.09 and 5.68% respectively, This was due to the higher weightage to food and beverage in rural CPI compared to urban, which makes rural consumers more vulnerable to food inflation. Core inflation persisted at around 6%. Unlike food and fuel, which fluctuate quite frequently, core inflation tends to be sticky and is indicative of a high price level permeating throughout the economy, which can take a bit longer to reduce. With this in mind, Monetary Policy Committee has not revised the inflation forecast for the fiscal year 2022 to 23, and it remains at 6.7% currently. Now we come to consumer confidence. November edition of RBI's Consumer Confidence Survey showed that consumer sentiments regarding the current situation continued on the recovery path despite remaining in the pessimistic zone. The current situation index increased to 83.5. 1 year ahead outlook, as measured by Future Expectations Index, also improved to 114.9 after remaining steady in the previous 3 surveys. Households displayed lower pessimism regarding current general economic situation, employment, and household income. However, perceptions regarding price level and spending deteriorated. Optimism regarding future expectations improved in most parameters. The outlook on discretionary spending moved to positive terrain for the first time since the onset of the pandemic. The impact of rising living costs was reflected in the year ahead expectations for price levels, which were negative and showed increased pessimism. Purchasing Managers Index. Purchasing Managers Index reached its 3-month peak in November. Services PMI increased to 56.4. Manufacturing PMI rose to 55.7, marking an expansion in business activity for the 17th consecutive month. This is an important positive sign considering the contraction reported by the Q2 GDP data. Easing of input cost inflation and revived demand are largely responsible for this uptick. Bank credit. The second quarter saw bank credit expand at an annual growth rate of 17.9%, an increase for the 6th straight quarter. Credit deposit ratio for this period was 74.8% against 70% in the corresponding period last year due to credit growth outpacing deposit growth in the recent period. RBI data for October 2022 shows that personal loans rose by 20.2%, driven by a surge in vehicle loans and housing loans. Food credit continued to decline, registering a reduction of around 59% on a year-on-year basis. Non-food credit grew at 18.3% in October compared to around 7% a year ago. Credit to all 3 sectors, that is, services, industry, and agriculture, saw improvement in the annual growth rates. Indian markets. Foreign portfolio investments have not been in India's corner this fiscal year. As per the NSTL data, in 2022, only July, August, and November saw net positive investments, of which August had the best performance. RBI's data for April to September period shows that investment by foreign institutional investors saw an outflow of $8,047 million. This can be attributed to risk aversion due to geopolitical and economic uncertainty in the world, as well as Fed hikes that affected India's interest differential negatively. Sensex and Nifty 50 gained 3.3% and 3.5% respectively in November. Nifty 50 gave 11.93% returns on an annual basis in November, while Sensex had annual return rates of about 5.6% in the month of October. The positive market sentiment was strengthened by record GST collections, dollars fall from peak levels, and upswing in FII investments. However, after Fed's latest rate hikes, both domestic indices fell by over 1%, in line with global corrections in response to the hawkish stance of central banks around the world. Public finance. As per NSO's data, government final consumption expenditure contracted 4.4% year-on-year in Q2 FY23, and its share in GDP reduced to 8.8% compared to 9.8% in the previous year. This may indicate a commitment to fiscal prudence as well as lending support to RBI's hawkish stance on monetary policy. In the April to October period, the government's total receipts amounted to 13 lakh crore rupees and have reached 60.7% of the budget target. Of the total receipts, revenue receipts contributed 13.50 lakh crore rupees. Tax revenue was 11.71 lakh crore rupees and the rest was non-tax revenue. The outlay for this period was 21.44 lakh crore rupees and is 54.3% of the budgetary estimate. Capital expenditure of 4.09 lakh crore rupees has been incurred so far, which is 54.6% of the government's target. Due to the significantly high burden of fertilizer subsidies in the aftermath of Russia-Ukraine crisis, 75% of budgetary allocation for subsidies has already been spent between April and October. Revenue deficit was at 3.85 lakh crore rupees or 38.8% of the fiscal year's budget target. India's fiscal deficit for April to October period stands at 45.6% of the budget estimates, amounting to 7.58 lakh crore rupees. Nevertheless, World Bank in its report India Development Update predicted that the government would successfully meet the fiscal deficit target of 6.4%. A high nominal growth in the first quarter of the year fueled strong tax collections, and that would help alleviate the rising expenditure. Public debt is also likely to decline to 84.3% of GDP in the current fiscal year. The gross GST revenue collected in the month of November 2022 is 1,45,867 crore rupees. Monthly GST collection has exceeded 1.4 lakh crore rupees for 9 straight months in a row now. The collection in November is 11% higher than GST revenues in the same month last year. The total revenue of centre and the states is 59,678 crore rupees for CGST and 61,189 crore rupees for SGST. In addition, the centre has released 17,000 crore rupees as GST compensation to states and union territories in November. The 48th GST Council meeting held on 17th December reduced the GST rates on husk of pulses from 5% to nil, and that on ethyl alcohol and ethanol from 18% to 5% to incentivize adoption of biofuels. Unemployment. As per the Periodic Labour Force Survey, PLFS, for July-September quarter, the overall labour force participation rate, LFPR, increased to 47.9% compared to 47.5% in the last quarter. Women's LFPR, increasing for the fifth consecutive quarter, was at 21.7%. Men's LFPR saw a marginal decline from 73.5% in Q1 to 73.4% in Q2 of this year. The gap between male and female participation rate remained largely unmitigated. The unemployment rate reduced to 7.2% from 7.6% in the last quarter. While male unemployment decreased, female unemployment remained unchanged. However, as this survey measures only urban areas based on the current weekly status, CWS, it is unable to give us a complete picture. Centre for Monitoring Indian Economy's unemployment data for November 2022 reported that India's unemployment rate at 8% has reached its 3-month peak. Haryana experienced the highest unemployment rate at 30.6%, while Chhattisgarh was the best performer with only 0.1% rate of unemployment. Urban employment rate outstripped the rural unemployment rate, standing at 8.96% and 7.55% respectively. Most of the jobs added in November were concentrated in rural areas, as evidenced by the fact that employment there increased by 4.3 million, almost 4 times that of urban areas where employment increased by only 1.1 million. High frequency indicators. The total volume of transactions via NPCI's Unified Payment Interface rose by 7.7% to 730 crores, and the total transacted value exceeded rupees 12 lakh crores in October 2022. The number of instant interbank fund transfers through immediate payment services in October stood at 48.25 crores and their total value was at rupees 4.66 lakh crores. The number of transactions increased by 4.3% and the overall value rose by 2.56% compared to September. The NETC FASTag, which facilitates automatic toll collection at NHAI's toll booths, reported a 9.3% monthly growth in the number of transactions, which stood at 28.3 crores in October. The corresponding value of transactions stood at 4,451.87 crores. Power consumption showed a positive trend, boasting a double-digit year-on-year growth rate at 13.6% in November 2022. The total units consumed in the month stood at 112.81 billion units. With this, we come to the end of the video. Thank you for watching our video. We hope you enjoyed it. What do you think about the direction of India's economic growth? Let us know in the comments below. Don't forget to like and share the video and subscribe to our channel for more.